You step into the market with a mental timeline that is already too tight and a reward picture that is already too bright. And from the first click, that gap between imagined speed and real progress begins to pull you off center. The issue is not only that price moves against you or that a setup fails. It is that your expectation engine has been tuned for acceleration and applause, while the work actually unfolds at the pace of skill acquisition. When the pictures in your head promise steep gains and a clean path, every ordinary fluctuation feels like a violation, and the nervous system interprets minor variance as danger. That is where execution decays. You start to adjust entries that did not need touching. You cancel stops because the loss feels premature. You stretch targets because a small win feels like proof that a bigger win is due. The problem is not the chart or the indicator. The problem is the mismatch between internal clocks and the tempo of professionalization. That mismatch generates affect load, the mental and emotional static that clouds working memory and narrows attention. With attention narrowed, you miss context cues. You chase, and you overfit your rules to the most recent tick. Losses that should be classified as a routine tuition are instead treated as a verdict on identity. So you seek relief, not information. Relief takes the form of impulsive trades, revenge entries, or a full retreat wrapped in a story about bad luck. The stakes grow with each cycle. Capital erodes, but the larger cost is the erosion of trust in your own process. When trust thins, protocol adherence collapses. Without rule fidelity, there is no stable execution. And without stable execution, the data you generate cannot teach you. What remains is noise, and noise has no memory. Social feeds intensify the squeeze by flooding your mind with highlight reels. You see gains without context and compare your messy middle to someone else's edited finish. That comparison compresses your survival horizon. You forget that staying power is the real advantage, not a single dramatic win. In this compressed state, the market starts to look like a judge with an agenda. But the market is only an instrument panel returning telemetry. It does not care. It reports. If you treat telemetry as praise or blame, you will read the dashboard like a horoscope and ignore what it actually shows, which is whether your entries align with your plan, whether your risk per idea preserves your learning window, whether your exits are consistent with your stated model. The stakes are practical and immediate. If you cling to shortcut expectations, you will cycle through strategies before any of them receive enough repetitions to become reliable. You will downshift to smaller time frames to chase stimulation, which multiplies decision points and multiplies error. You will keep changing the rules that were never given a fair trial, then conclude that you lack talent, when the real deficit is time under structured practice. On the other side, if you recalibrate expectations towards slow professionalization, you create room for repetition to shape your skill. You lower cognitive noise because the target is no longer instant payoff, but clean execution. Clean execution creates a data trail you can trust. Trust in the data rebuilds trust in yourself. That trust lifts your survival horizon because you now experience losses as information, not as identity threats. This is the shift we are after. We will replace shortcut thinking with an operating model that sets clear definitions for acceptable risk, clear triggers for action, and clear limits for daily exposure. We will put your attention on behaviors you control rather than outcomes you cannot command. We will use the unbiased scoreboard of your own logs to calibrate your next adjustment. The immediate goal is not a sensational equity curve. The immediate goal is process regularity that keeps you in the game long enough for edges to express. If you accept that premise, the emotional charge around each trade begins to fall, and in that quieter space protocol, adherence becomes possible. Consistency is not a virtue signal. It is a throughput system. Build the system, and the system returns time. And time is the doorway to continuation advantage. You are running a decision loop that begins before any candle prints and long before any order hits the book. And the loop is shaped by internal state more than by external price. Sensations and thoughts create a baseline that either widens or narrows your perception window, and that window decides what you notice on the chart and what you miss. When arousal rises and affect load increases, the brain turns up the volume on signals that confirm the desired outcome and mutes signals that contradict it. The same chart now looks different because your gating has changed. With gating narrowed, you misread normal variance as danger and you classify harmless noise as a threat to your plan, which produces urgency. Urgency shortens time horizons, shrinks working memory, and pushes you toward default shortcuts. Shortcuts are not evil. They are energy-saving patterns. But in trading, they often bypass the very rules that keep risk bounded. The result is a shift from planned execution to reactive impulses. The internal model that drives this shift is simple. Input arrives from two sources: market telemetry and body telemetry. If body telemetry reports tension, rapid breathing, or a racing heart, the brain elevates the cost of waiting and devalues patience. If body telemetry reports euphoria after a quick gain, the brain elevates the appeal of repetition and discounts caution. In both cases, the appraisal system tilts the expected value calculus. You begin to prefer actions that resolve tension fast, even if those actions have poor expectancy. That is why revenge entries feel magnetic, and why bailing at the first pullback feels wise in the moment, even when your plan says, hold. The loop continues into intention formation, where rules should translate into specific if-then actions. When effect load is high, working memory can hold fewer rule elements at once. You remember the entry trigger, but forget the invalidation criteria. You remember the win target, but forget the time stop. You recall a recent breakout, but not the context filter that would have kept you out of a low-quality imitation. Each omission seems small, yet each one increases variance and erodes repeatability. In the action phase, the body introduces micro-delays and micro-accelerations. You hesitate on valid triggers and you rush on marginal ones. You nudge a stop because loss feels personal. You stretch a target because a small win feels like a promise of more. These are not moral failures. They are predictable outputs of a system that lets state drive execution. Then comes feedback and memory. If you fuse results with identity, the brain tags losses with shame and tags wins with proof of worth. Shame compresses exploration and kills curiosity, so you avoid reviewing the trades that could teach you the most. Proof chasing pushes you to enlarge size too fast and to stack trades that share the same risk drivers. Both distort the true signal in your data. This is how strategy hopping emerges. It is not always boredom. It is often an attempt to outrun a painful tag that got attached to a set of rules. The schedule of reinforcement inside markets adds another layer. Outcomes do not pay on a fixed schedule, and the size of payoff varies. So compulsive checking is rewarded often enough to train the behavior. That same variable payout trains you to overestimate your control and underestimate base rates. The instrument panel keeps reporting neutral information, but your reading of it is colored by state. You start to search for meaning in streaks that are statistically ordinary. You overinterpret a cluster of winners and you overcorrect after a cluster of losers. Reference points drift. After a few fast wins, you redefine normal. Then a flat day feels like failure, and you reach for stimulation on a smaller time frame. Every drop in frame size multiplies decision points and multiplies error opportunities. The survival horizon shortens because you burn attention faster and invite more slippage, more commissions, and more fatigue. Social inputs push the loop in the same direction. Highlight reels build an external reference that makes your current skill acquisition curve look slow and makes patience feel like weakness. The result is a rising urge to escalate risk or to switch playbooks before the repetitions that create reliability have accumulated. The mechanism can be summarized in 4 verbs: sense, appraise, intend, act. Sense is the mix of market telemetry and body telemetry. Appraise is the quick calculation of what this means for me right now. Intend is the selection of a rule and a timing plan. Act is the motor output that places that, adjusts, or exits the order. Distortion can enter at each verb. If you sense through a narrow window, you gather the wrong inputs. If you appraise through the lens of fear or euphoria, you misprice risk. If you intend without full rule retrieval, you pick partial procedures. If you act under pressure, you tilt toward urgency moves. The fix begins by inserting buffers at each verb. You aim for wider sensing through deliberate slowing at entry moments so that body telemetry is seen and not obeyed. You aim for cleaner appraisal by translating goals into numbers before the session so that value is priced by rules rather than mood. You aim for stronger intention by rehearsing rule retrieval until it is automatic, and by limiting concurrent rules to a small set you can truly hold. You aim for more precise action by automating order placement where possible and by capping discretionary adjustments to a few predefined conditions. Those buffers do not remove emotion. They reduce how much emotion can redirect the loop. When buffers are present, you create a separation between the instrument panel and the self. You read the panel instead of reading your hopes. Now the same candle no longer triggers a flight response. Now, a small loss is not a verdict. It is just a data point that keeps the calibration cycle running. Once the loop is stable, the same rules produce similar outputs across days. And that repeatability is the foundation for process regularity and the continuation advantage that compounds over time. Operating principles turn a vague intention into repeatable execution. So we begin by defining a risk unit as the fixed amount you are willing to lose on a single idea, and we treat that unit as the atomic building block of every decision that follows. A position is valid only if its stop distance and size combine to equal that risk unit, not an inch more. This creates rule fidelity, because each idea consumes the same slice of your learning capital, and your nervous system stops negotiating with loss magnitude during the trade. Next, declare a setup validity gate that states the conditions that must be present before you can even consider an entry. The gate includes market context, the pattern level trigger, the WARD, invalidation price that would prove the idea wrong, and a time and trade limit so that stale trades do not drain attention. The invalidation level is not a suggestion. It is the price that falsifies the premise. When that level is touched, the premise is gone, and staying inside is no longer trading. It is hope. Now add an execution hygiene rule that standardizes how orders are placed. Preload your stop and target. Use bracket orders where your platform allows. And restrict manual adjustments to a short list of pre-declared conditions, such as a clear structural break or a session boundary that aligns with your model. This reduces the number of decisions that can be corrupted by mood, and it shrinks the surface area where error can enter. Tie all of this to a daily exposure cap that limits the total loss you can take in a session and a session shutdown trigger that activates when your error rate or effect load crosses a threshold. The purpose is not to avoid effort. It is to protect the calibration loop that keeps you learning. You also need a clear expectancy frame. Expectancy is the average return per trade measured in risk units, and it is a function of win rate, average win, and average loss. You do not need perfection to be profitable. You need a positive expectancy executed with stable behavior over a sample large enough to reveal the signal. Let this math guide your emotions. A small cluster of losses inside a positive expectancy system is not a verdict. It is variance. Use a base rate tracker to record how often your setups meet target, how often they meet the first scale condition, how often they time out, and how often they fail at the invalidation level. The base rate is your friend because it anchors judgment to frequencies rather than to the feelings of a single day. Instrument panel framing keeps you honest. treat your journal and stats as flight. Telemetry. Each session, the panel tells you three things that matter: adherence, latency, and slippage. Adherence is the percentage of trades that fully matched your validity gate at the moment of entry. Latency is the delay between trigger and action, which reveals hesitation, drift. Slippage is the difference between planned prices and executed prices, which reveals rushed behavior or thin liquidity. When adherence is high and latency is stable and slippage is contained, you are reading the panel rather than your hopes. When any of these drift, you adjust the lever that fixes it. Add a pre-flight pause if latency spikes. Reduce time frame exposure if slippage grows due to noise. Rehearse rule retrieval if adherence dips because memory failed under strain. Another operating principle is rule retrieval on demand. Before the session, practice recalling your entry trigger, invalidation, sizing logic, and exit logic without looking. This rehearsal shifts the rules from brittle knowledge to procedural memory, and it lowers the load on working memory under pressure. During the session, limit the number of concurrent playbooks you can run. Depth beats breadth because repetition builds automaticity, which in turn reduces cognitive noise. Add a clarity phrase for each setup, a short sentence that states the edge in plain language, so you can hear it in your head before you act. If the phrase does not fit the live chart, you do not have your setup. Finally, close the loop with a debrief that is designed to teach rather than to punish. Tag each trade for adherence, context quality, and error type. Distinguish between a clean loss that followed the plan and a process error that violated a rule. Only the second requires a corrective action. Draft a tiny contract with yourself that describes exactly what you will do differently in the next session, and limit it to one change at a time so you can isolate the effect. The aim of these principles is not to sterilize trading. It is to channel your attention toward the small set of behaviors that control risk and produce repeatable data. When these definitions and rules are in place, the market becomes an unbiased scoreboard, and your job becomes simple. You read the panel, you execute the procedure, you record the result, and you adjust the lever that the data identifies. Over days and weeks, this creates process regularity. Over months, it creates the continuation advantage that separates the trader who stays from the trader who quits. Implementation begins with a pre-market calibration that sets your state and your rules before you face live price. Rate last night's sleep on a simple scale and scan for tension signals like jaw clench and shallow breathing. If the score is poor or tension is present, run a 2-minute breath cycle with a slow inhale, brief hold, and longer exhale to lower arousal. Open your platform only after this reset. Confirm your risk unit. Confirm your daily exposure cap. Confirm your shutdown trigger. And rehearse rule retrieval for your primary setup by speaking the entry, trigger, the invalidation level, the sizing logic, and the exit plan from memory. Write a single clarity phrase that states the edge in plain language and make sure it fits the current conditions. If it does not fit, you are in observation mode, not in action mode. Prepare your symbol list and mark the session windows when you usually see clean structure so that you do not chase during thin periods. Align chart layout, hotkeys, and bracket order templates so that placement is standardized and the number of manual choices is minimized. During the first minutes of the session, stand back and let the opening behavior reveal its character before you engage. Your rule is that the first valid trigger can only be taken if both context and pattern conditions are present. If either side is incomplete, you watch without regret. When a valid idea appears, place the order with the preloaded bracket. Confirm that size equals the risk unit, and log an immediate pre-trade tag that captures adherence, context quality, and state rating. While in trade, protect working memory by following a small set of if-then checks. If price closes beyond the invalidation level, you are out without debate. If price reaches the first scale condition, and the plan calls for partial, you act and adjust the stop to the new level. If that rule is part of your playbook, if price stalls and the time and trade limit is reached, you close it and record the outcome as stale, rather than try to force movement. Build intraday resets into the schedule so that state does not drift. After any exit, step away from the screen for 1 or 2 minutes. Look at a distant point to relax, eye focus. Breathe slowly, and name your current state in a single, neutral label. This creates separation between the last result and the next decision. If you register rising, agitation, or euphoria, switch to observation for a short interval and let the meter settle before you allow another order. Guard your attention with a distraction firewall. Close non-trading tabs. Mute notifications. And put your phone outside reach. Keep a glass of water and a simple timer on the desk, and use the timer as a cue for posture resets so that fatigue does not masquerade as urgency. Limit concurrent playbooks to a small number so that rule retrieval remains crisp. If you catch yourself mixing rules, freeze action. Revisit the clarity phrase and decide which single playbook is active. Establish error handling that protects the calibration loop. A process error is a violation of a rule, not a clean loss. 2 process errors in a session trigger a cooldown. The cooldown is a short walk, a breath cycle, and a review of the last 2 decisions to identify the lever that failed. If the same error repeats after the cooldown, the session is done because the learning window is compromised. Build a correlation check into your risk view. If multiple instruments share the same driver, treat them as one idea and divide size rather than stack full risk across each ticker. Use a time-based stop on sessions with a flat range and poor follow-through so that you do not grind away attention for little expected value. At the end of the day, run a brief debrief that turns the log into guidance. Tag each trade for adherence, latency, and slippage. Then write a 1-sentence observation about what drove each metric. If adherence slipped, rehearse rule retrieval. If latency grew, add a pre-flight pause before order placement. If slippage expanded, examine your time frame and your entry method and consider tools like limit orders at obvious levels rather than chasing at market. Extract 1 improvement lever for tomorrow and only 1, so you can isolate cause and effect. File annotated screenshots for any trade that teaches a clear lesson and label them by setup, name, and context, so they are easy to retrieve during the weekly review. The weekly review promotes base rates and refreshes confidence in frequencies over feelings. Tally how often each setup reaches target, how often it scales, how often it times out, and how often it fails at invalidation. Compare this to the prior sample size and note drift. If a setup's base rate degrades, reduce its size or shelf it for a cycle of practice and redefinition. If a setup strengthens, do not rush and to enlarge size until adherence stays high across a meaningful number of repetitions. Finally, prepare a recovery plan for drawdowns. When equity drops by a preset number of risk units, cut size in half and shift to the highest quality windows only until adherence and expectancy stabilize. These tools and routines do not make the work easy. They make it governable. They convert mood into signals you can measure and turn those signals into levers you can move. With practice, the day becomes a sequence of small, clean actions, and those actions produce a trail of data that can be trusted to guide the next adjustment. Integration is the move from isolated tactics to a living operating system that runs every day without drama. So begin by defining the loop you will repeat forever. Decide, execute, capture telemetry, reflect, adjust. Decide means you select one setup that actually fits live conditions using your clarity phrase as the filter. Execute means you place the order with the bracket already prepared, and you let the plan work without decorating it with impulse. Capture telemetry means you record adherence, latency, slippage, state rating, and risk used in clean language while the details are still warm. Reflect means you read the instrument panel after the trade and after the session to see which lever moved and which lever drifted. Adjust means you choose one lever for tomorrow and only one so you can see cause and effect. To make this loop measurable, you will separate lead measures from lag measures. Lead measures are behaviors you can control, such as rule fidelity, timing, discipline, and exposure control. Lag measures are outputs you cannot force, such as profit and loss for the day. Your scoreboard will weight lead measures first, because lead measures create repeatability, and repeatability produces the results you want over time. Write a simple rule that says, today is a success if adherence stays high. Latency remains within your range. Slippage is contained. And daily exposure stays inside the cap, regardless of whether the day ends green or red. This reframes your identity around process regularity rather than result spikes, and it protects your survival horizon. Use small rolling windows to keep the scoreboard current. A window of the last 20 trades is often enough to see drift without waiting too long to act. Plot adherence, latency, and slippage as simple averages, and keep a short note on the dominant error class that appeared in that window. If adherence falls, tighten your validity gate and rehearse retrieval before the open. If latency grows, insert a pre-flight pause and remove one conflicting playbook. If slippage expands, favor, limit orders at logical levels, or widen the time frame to reduce noise. Tie sizing to behavior rather than mood. When adherence and slippage meet your standard across a full window, consider a small size increase that still respects your risk unit. When either drifts, cut size and stabilize before you think about growth. This removes ego from sizing and links risk to execution quality. Treat expectancy as a calibration tool rather than a trophy. Expectancy in risk units is the average outcome of your setup across the last window, and it changes as market conditions change. When expectancy shrinks but adherence is steady, you may be facing a regime shift, and the correct move is to reduce exposure or narrow your sessions, not to force trades to make up numbers. When expectancy rises and adherence holds, you harvest and still protect the loop because streaks do not change the rules that keep you safe. Build a weekly review that upgrades decisions rather than collects screenshots. On one day each week, step back and ask 3 questions. What behavior improved that I can lock in with a rule? What behavior degraded that I can fix with a lever? Which context features aligned with my best trades so I can focus my attention there? Use these answers to edit the playbook with tiny changes that accumulate. The continuation advantage emerges when your loop keeps running during both noisy periods and clean periods. Continuation advantage is the compounding effect of staying in the game with a stable procedure while others burn out or stall. It is visible in your data as a rising count of clean repetitions, a stable adherence line, and a variance that shrinks as errors fall. It is also visible in your stress profile as fewer spikes and shorter recoveries after mistakes. You do not need dramatic wins to get here. You need days where nothing exceptional happens except another set of clean actions. Protect that pattern with boundaries that honor the human battery you trade with. Cap screen time so attention does not fray. Use breaks on a timer so posture and breathing reset your baseline. Keep a shutdown rule that stops the day when error count or effect load crosses your line. Even if the day ends flat, the goal is to keep your learning window open tomorrow. Bring these elements together in a simple daily script you can say out loud before the first trade. Today I trade one setup that fits my phrase. I size to the risk unit. I place with a bracket. I obey invalidation. I act only on pre-declared adjustments. I log adherence, latency, slippage, and state. I shut down on 2 process errors or when the exposure cap is reached. I review once and I choose one lever for tomorrow. This script is not theater. It is an anchor that keeps you inside the procedure when pressure rises. When you are ready to extend this work with others, step into a practice room built for accountability and steady progress. You want a place where members post adherence scores, share execution logs, run weekly drills on rule retrieval, and help each other hold the line on exposure and shut down triggers. You want structured themes rather than noise, and you want moderators who keep the culture focused on procedure over prediction. If that is useful, join the Mind Over Markets community. Introduce yourself with your clarity phrase and your risk unit, and commit to one small improvement lever for the week. Subscribe so the next session finds you. Leave one sentence below, naming the lever you will adjust tomorrow, and carry this loop into your next session. The market will continue to print without praise or blame. Your instrument panel will continue to report without judgment. Your job is to keep the loop alive and let time turn clean repetitions into a skill that does not depend on mood. And that is how you build a stable execution stream and a survival horizon long enough for your edge to express.